Welcome to my Canadian HELOC Dividend Investing channel. This is where I'm going to share with you how I'm going to get to financial freedom using the HELOC Dividend Investing strategy. And just in the last 2 months, my account have already gone up 66,000, and I'm going to show you how. So let's get started. HELOC is short for Home Equity Line of Credit. It basically uses your home equity value as leverage for investing. The main benefit of this is the interest paid on this HELOC loan can be tax deductible. So shopping around for HELOC rate, as of today, May 9, 2021, we have Tangerine at 2.35%. The prime rate is at 2.45%, and majority of the banks can offer 2.95%. I'm going to map up 3 scenarios using these 3 HELOC rates, and based on my scenario of taking out a $650,000 HELOC investment loan, you can see that the annual interest for a 2.35% interest rate would be around $15,275 that I would have to pay annually in HELOC interest. The Ontario marginal tax rate for myself is 43.41%, and this is dependent on your province and territory and the amount of income that you're currently making. I have the URL linked to taxtip.ca that you could find out what your marginal tax rate might be. The dividend yield that I'm assuming the account will generate is 5%. So the annual dividend, which is your loan times your yield for this scenario 1, is $32,500. The Ontario dividend marginal tax rate for myself is 25.38%. And again, check the taxtips.ca website to get your dividend marginal tax rate. When you apply the formula dividend times dividend tax rate, you get your annual dividend taxes that you will have to pay on your annual dividend. So for my scenario 1 is $8,248.50 I will have to pay in taxes. The HELOC interest tax deductible amount, which is your interest paid times your marginal tax rate, you get $6,630.88. So this would be the amount that you can claim back during tax time. So your total or your net earnings would be as your dividend received plus your tax deductible minus the interest paid and taxes paid. So for scenario 1, we have a net earning of $15,607.38. So this is the profit that you will make based on scenario 1. So because of your HELOC tax deductible, your effective interest rate on this HELOC loan becomes 1.33%. Your break-even dividend yield would need to be 1.78%, meaning if your 5% dividend yield drops to 1.78%, then you break even. Another way of looking at this is your HELOC interest rate have to rise from 2.35% to 6.59% for this break even. So if your dividend yield drop below 1.78% or your HELOC interest rate rise above 6.59%, then it doesn't make sense for the strategy because you'll earn less than what you're bringing in. So when you look at scenario 2, the only difference is the interest rate has gone up 0.1%. And you can see that the net earning difference is about just under $400. And when you look at the scenario 3, which is 2.95%, you see that it's a little bit bigger difference, right? The net earning difference is just over 2,200. Okay. If you want to follow this strategy, you have to keep here's some tips for you. You can ask the lender to cover the appraisal and lawyer fees. In my scenario, I went with Tangerine, and they cover the appraisal fee and gave up to $750 to cover the lawyer fee. The lawyer fee can run you to around $1,000 to $1,500 depending on the lawyer you use. The HELOC interest loan, to be deductible, you need to make sure the investment must have an expectation of generating income, right? Example, eligible dividend. Some companies such as REITs, income fund, ETF, they pay out a distribution or dividend that includes ROC, which is return of capital, which is not tax deductible. Investment must be in a non-registered account, so it can't be in an RSP, RESP, TFSA account. I suggest you to create a separate checking account and a non-registered account for ease of bookkeeping, so you don't mix your regular funds and your other trading accounts with this HELOC loan. Because when it comes to tax season, you need to be able to show how much interest you paid and if you sold or bought any new funds. Easier to book for your bookkeeping. And you need to be comfortable with leveraging, right? And you must have a long-term investing horizon, 10 plus years, that can withstand market drops such as the financial crisis in 2007 and 8, and more recently the 2020 COVID-19 pandemic, where the market dropped 30 to 40%. And here it is, my snapshot view of my portfolio from March 8th, that's when I started, to May 9th, just about 2 months. My portfolio profit is $65,488. So $59,500 of that is from capital gain, unrealized capital gain, because I haven't sold anything yet. And $5,986 is from dividends, right? And the snapshot of my portfolio, you can see that I'm heavily on telecom, 45% telecom, 21% utilities, 19% energy. I have some industrial, insurance, and consumer staples. Right. In the next video, I'm gonna go into my holdings a little bit further. Comment below what you think of this strategy. Are you doing it as well? How well your portfolio is performing, right? If you like to follow my journey, hit the like button, subscribe to my channel, and I'm going to post the next video in a weekly basis to show you how my portfolio is doing. And again, next video, I'm going to show you how I came about selecting what I selected for this portfolio and what I'm thinking going forward. Okay, see you in the next one.